And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Tuesday already as we rolling through this week already. Just here we go. Get ready to wrap up the month too already. I told you when we came back from the Christmas break that we welcomed you into January. We said, you know what? You need to start shopping for Christmas. It'll be before you know it.
Don't blink.
Don't blink. It's already gone. So, yeah, spring break's coming up.
Yeah.
This is a big year for the Roberts household, by the way.
Oh?
Big year for the Roberts household. Right. We got spring break coming up. Then we have May coming, and then I've got 2 kids out of the house. So I'll be down to 1 kid left.
Off the payroll.
Yep.
Yeah.
Off the payroll, off to college. Yeah, I don't pay for their college. That's on them. So I keep encouraging them to go the military route, but they're not listening to me. But anyway, big changes this year. So it's going to start to really quieten down around the Roberts household.
Mm-hmm.
So
yeah.
Very excited about this because I love my kids. They are the light of my life. They're teenagers, and they're driving me crazy. So, I used to watch all these videos about how people, talked about their teenagers.
Yeah.
I get it. I get it.
They weren't exaggerating.
Was Adam that way?
Oh, yeah.
He was?
Oh, I've got stories.
We should swap stories.
We should stop.
All right. Hey, that's not what you want to hear about. You want to hear about what happened yesterday. So yesterday morning, of course, we started off the day in a pretty negative red territory. And in fact, most of the day was pretty negative during the first part of the day as we were really kind of getting into the market itself. Really started selling off strongly. We were down about 4% on the NASDAQ in particular, as we really started seeing a lot of real bleed in the markets altogether. And in fact, as we got further into the morning, the market sell-off just kind of continued on and got more and more pressure. And we've been talking about for the last few days, hey, we were due for a bounce. We had all this options expiration on Friday. We were expecting a bounce yesterday morning. Certainly didn't happen, and got a lot more selling pressure. Now, we saw about a tremendous amount of volume yesterday of stocks being dumped, particularly at the open. And this happened all morning. And then about 11 o'clock or so yesterday, started seeing some kind of bottoming of this rally. So, no, battery died. Hi. So anyway, we're back now. Sorry, lost our mic there for a second. But it's dead. My mic died. Not sure what happened to it anyway. But so you leave the chart up for a second. But what happened is yesterday, of course, we had this complete rebound and reversal in the markets yesterday. So again, what does that mean? That's kind of the big question at this point. Is, how do we get from, yesterday and now this morning, futures are starting to point back lower once again. Dow's down about 261 points here at the open this morning. Implied, S&P and Dow, NASDAQ are going to be down well over 1% again this morning. But again, the good news is we were down 4 yesterday, recovered all of that. So we've got, 4% of downside to go before we get back to yesterday's low. So, there's a little bit of breathing room here, I should say, for the correction, and it doesn't look like the selling pressure's done yet. Now, this is all in advance of. Now, tomorrow, importantly, is the Fed meeting. Now, this is going to be where we find out just how aggressive and just how committed, I should say, the Fed is to potentially hiking rates and really working on this kind of inflation binge that they've been worried about. Of course, and this was all driven by this massive flood of monetary liquidity, that $5 trillion worth of checks to households and extended unemployment benefits, all that, certainly led to this excess capital that everybody had to spend, and they went out and they spent it. And then, of course, the economy was shut down, so it's led to this inflation. Now, the problem is for the Fed is they've got a real challenge here. They have to understand that the inflationary surge we're seeing in the economy is artificial and it's only temporary. Because now that the liquidity is already coming out, that's being reduced. All those child tax credits are gone. All the extended unemployment benefits are gone. The checks to households have long been spent. So that demand is already starting to show signs of weakening. In fact, if you take a look at markets PMI, Manufacturing and Services Index, they have clearly peaked and rolled over here. Not surprising. That's, nothing that. We're starting to see clear evidence, yield curve flattening, et cetera, that we're starting to see economic growth slow down. That's deflationary in nature. And so a lot of this surge that we saw in the markets was created by this artificial surge of liquidity, this massive push of M2 money supply, just ramping up to high degrees, and of course that hit the economy at a time we were shut down. So that led to this big price surge. Now this is all starting to reverse. Now that liquidity is coming out and supply is coming back online, so you're going to get deflationary pressures. That's just the way the economy works. So the challenge for the Fed, though, is they've kind of committed themselves at this point to battle this inflationary surge. And they're talking about aggressively hiking rates and balancing their balance sheet, reducing the size of their balance sheet. And this is really what the markets is looking at. Are they going to be committed to that? And I kind of wrote this in a tweet this morning. I said the market's calling the Fed's bluff here. So the Fed's been talking very aggressively about trying to get, this inflation under control, but the market's kind of front-running what the Fed is doing here. And this will create deflationary pressures all on their own, because as people see their asset values declining, they start saying, what, I'm not going to go spend that money I was going to spend because, man, I don't know what's going on with the markets right now. So you kind of get this built-in effect. Maybe that's what the Fed wanted. Maybe this whole thing by the Fed was simply just to talk the markets down. We'll see. We'll see what they say tomorrow. If the Fed comes out tomorrow and says, well, we're kind of watching things and inflation's starting to moderate here and we're going to continue to kind of watch here for another month or two, the market's likely going to scream higher at that point. The market will understand that the Fed has now been caught. If the Fed comes out tomorrow and says, we're sticking to our plans, sticking to our guns, we're going to be hiking rates and tapering our balance sheet, probably going to have more sell-off in the markets. And that's really what the market's trying to front run right now, is really trying to get ahead of a more aggressive Federal Reserve. So we'll see. We'll see what happens. The issue, though, and again, when we take a look at yesterday, the sell-off that we had, so we were down 4% kind of on the NASDAQ at the nadir of the markets yesterday. And then all of a sudden had this massive rebound, and the markets wound up almost, a point higher. So just a complete, you had a 1,400 point swing in the Dow yesterday. The Dow was down 1,000 points yesterday. We haven't seen that since March of 2020. And we haven't seen days where we are down 1,000 points and swing back to positive, but only on 5 occasions previously. 2 of those occurred during the dot-com bubble. 2 of them occurred in the midst of the financial crisis, and the 5th one was during the Asian contagion in 1997. Talk more about this when we come back from the break. I'm your host, Lance Roberts, realinvestmentadvice.com. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will the Fed's actions this week mean for your money next week? Join Lance Roberts with Richard Rosso and Danny Ratliff for a special edition of Candid Coffee this Saturday, January 29th at 8 a.m. We'll address market conditions post-Fed meeting. Will it be slow or go for Wall Street? And how will the Fed's stance affect your investments? Register now for our special edition post-Fed Candid Coffee at realinvestmentadvice.com. Candid Coffee with Ratliff, Rosso, and Roberts. realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. Realinvestmentadvice.com. Click on the insurance tab.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So, I want to show you something here as we kind of talk about this. You know, and this is important to understand here because there's a lot of, you know, as we're talking about the Fed and we're talking about the, you know, their view about inflation, and really this kind of permeates into the rest of the markets as well. There's a lot of people right now chasing the commodity trade. And, you know, it's like, oh, you know, inflation's going up, so I need to buy, you know, all these commodities, these type of things. And nothing wrong with that, right? It's kind of that belief that if you're going to have surging inflation, and again, as soon as, you know, we do have a very strong rate of inflation currently. And if you go back to the 70s, that's, you know, first of all, most people haven't been alive that are investing in the markets, you know, by the 70s. But, you know, when I was growing up, I remember, you know, the 70s and, you know, the gas lines and all this. Back in the day, back then, you had this meter on the side of your house that metered your electricity, right? It actually just stuck to the house and it metered how much electricity you use. And so I remember, though, I mean, my dad was just worked at a chemical plant and, you know, worked in a manufacturing plant. And, you know, my mom was, you know, teaching school. And so money was tight and inflation was surging, you know, sharply back then, and costs were going up. And about once a month, my dad knew about the time that the meter man would come around and meter the house. And he'd go outside and you could unscrew. Do you know what I'm talking about?
Oh, yeah.
Yeah. So you could unscrew the meter, and then we would all be sitting in the house, and I would have to hold the flashlight for him, and then he'd roll the meter back on the electricity to keep our bill down, right? Can't do that anymore.
Pretty sure the statute of limitations has run out on that story.
Well, they can go get him. He passed away. So I can tell that story now, but yeah. Go get him. I'll show you his new address. But I mean, look, I mean, people were doing everything they could back then to try to curtail costs. And again, it was gas lines and all this. That was inflation. And that was sticky inflation because it was persistent and it stayed, right? I mean, this is, you know, it was a challenge. Currently, we have a lot of people throwing back to those days, right? Going, oh, this is like the 70s. And if inflation's going up, we need to buy hard assets and commodities and all these type of things. Okay, and there's a difference. And I'm not saying that, let me be clear, I'm not saying that inflation can't be persistent for a while longer, but there is a difference. Back in the 70s, you had very strong rates of economic growth. We were growing at 6, 7, 8% annualized at the time. Interest rates were coming up. You had a very strong manufacturing-based society, which has a very large economic throughput, about $5 for every dollar input into it. Versus today, where we've moved into a financialization economy where deflationary pressures are persistent, much more so than inflationary pressures. Now, I wanted to show you this chart. So we wrote about this last year. So I have a chart up. If you are watching our live stream, you can see it now. If you're driving, don't try to watch the live stream. I'm going to explain it to you. It's fine. But this, I just took M2 money supply and I went back to 2000 and I said, what's kind of the correlation between the increase or decrease in the supply of money in the economy versus inflation. And there's about a 9-month, and this chart I published back in early 2021, okay? And it was saying, look, this is about March of 2021. I said in about 9 months, inflation's going to show up because M2 has about a 9-month lead over inflation. Why is that? Well, if I just sock a whole bunch of money into the economy today, I've got to get it to you. You've got to go spend it in the economy. And it takes time to work its way through. It takes about 9 months to work its way through the system. And the reason I wanted to show you this was in our article that we wrote yesterday, and which was the Fed won't be able to hike rates nearly as much as they expect. And this chart was kind of the key measure behind that because I updated the chart now 9 months later, and what you see is now that surge in M2 money supply, inflation has caught up to it, just as you would have expected it would. About 9 months later, voila, we have inflation because we slammed all this liquidity into the markets. Now, importantly, M2 is dropping drastically now, which, if the correlation holds true, and theoretically it should, inflation is going to start to drop over the next few months as that liquidity continues to come out of the system. Now, on top of this, you've now got the Fed talking about hiking rates and tightening money supply, which is going to pull more liquidity out of the system. The federal government, the current administration, can't get bills passed, so there doesn't seem to be at the moment any more funding bills in terms of Build Back Better or whatever. They seem to be just tripping all over themselves in the administration now, trying to get anything done. So it doesn't seem to be any more monetary policy, or I should say fiscal policy, I apologize, coming our way anytime soon. So there seems to be more drag on liquidity at the moment than there is impulse. And so the reason I'm bringing this up is because, again, I think while the Fed is talking a tough game about hiking rates and doing these type of things, if you look back to 1982, right? So here we are, late 70s, right? Surging inflation. Paul Volcker comes in and says, hey, he's going to team up with Ronald Reagan here, and they're going to break the back of this inflation and surging interest rates. Now, remember, interest rates were 14, 15% back in the late 70s. And people having to deal with borrowing costs. But again, economic growth was exceptionally strong. I mean, 8, 9% growth rates in the very late 70s. I mean, the economy was booming. That's why interest rates were up. Inflation was up. The economy was growing very strongly. But Paul Volcker came in and said, we need to stop this. And that was really the initiation of the active Fed. and the Federal Reserve started hiking rates and started bringing down that rate of inflation. And ever since then, ever since the Fed's become active, every time the Fed starts a rate hiking campaign, you either get a pretty severe bear market, some type of financial crisis, or some other type of monetarily related event, savings and loan crisis, Pennsylvania, Orange County, Asian contagion, long-term capital management, .com crisis, financial crisis, you name it. And here's the interesting part about all of this is that every time the Fed has hiked rates, the peak of that interest rate hike has always been lower than the peak where they previously hiked rates and created a problem. So, for instance, in 1991, when they were hiking rates, it caused the 91 recession, and Fed funds rates were running, roughly around, 5%. Ever since then, that's been going lower and lower and lower during that time frame. So, again, this is one of those kind of interesting bylines, is that the Fed likely has much less room to operate than what they currently think. And again, we go back to, really kind of taking a look at, Treasury yields and what happens in the bond market. And bond market's really kind of that risk-off indicator, is that as the Fed starts hiking rates, you would expect, and I get this question all the time, Lance, why do you want to buy bonds here? Because the Fed's hiking rates. Yes, they're hiking rates on the short end of the curve. So they're bringing up very short-term borrowing costs. But the long-term borrowing costs, 10-year, 20-year, 30-year bonds, those are more tied to economic growth. So as you start hiking interest rates on the short end, that's going to start slowing economic growth, and that's going to bring yields down on the longer end. And in fact, every time the Fed starts into their quantitative easing programs, that's exactly what happens. And so as they end these programs, rates rise during the midst of these programs, which is exactly what's happened, because the Fed's juicing the economy with all this liquidity, which is driving asset prices up. And so there's a risk-on attitude, so people sell bonds to buy stocks. But when that policy ends, stocks tend to perform worse and money flows in the other direction. 2018 is a good example of this. In 2018, the Fed's hiking rates and tapering their balance sheet, and they say, hey, we're nowhere near the neutral rate. And yields are already falling, and yields plunged between October and December until the Fed, reversed course very quickly and said, you know what, hey, just teasing about those rate hikes. Yeah, we're right there at the neutral rate. Of course, 6 months later, they're actually cutting rates back to zero and starting to bail out banks and hedge funds in September. And then come March of the next year, injecting $120 billion a month in QE again. Will this time be different? Maybe. But I think it's worth paying attention to what they say tomorrow, because that will be really the key indicator for what happens in the markets between now and until they start doing QE again. Be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
What will the Fed's actions this week mean for your money next week? Join Lance Roberts with Richard Rosso and Danny Ratliff for a special edition of Candid Coffee this Saturday, January 29th at 8 a.m. We'll address market conditions post-Fed meeting. Will it be slow or go for Wall Street? And how will the Fed's stance affect your investments? Register now for our special edition post-Fed Candid Coffee at realinvestmentadvice.com. Candid Coffee with Ratliff, Rosso, and Roberts. realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the Insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Several of my neighbors all bought Pelotons. They are now coat racks, which is usually the case with home exercise equipment. We burn through treadmills probably once a year. We never buy a new treadmill. We buy treadmills on Facebook for like $100 because people go buy these treadmills, they turn them into coat racks.
The Real Investment Show podcast. Same show, your schedule.
The best part is, in a lot of cases, they'll deliver them to your house for free.
At realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
What will the Fed's actions this week mean for your money next week? Join Lance Roberts with Richard Rosso and Danny Ratliff for a special edition of Candid Coffee this Saturday, January 29th at 8 a.m. We'll address market conditions post-Fed meeting and how will the Fed stance affect your investments. Register now for our special edition post-Fed Candid Coffee at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. You know, one of the interesting things about the economy right now, and I've written about this numerous times in the past, you know, this, and most people have disagreed with me, and that's okay. But, you know, when you take a look at the economy and you take a look at how we report employment is a good example, right? So, according to the Fed, we're nearly at full employment. And we've got 4.2, 4.5% unemployment rate. Now, what does that mean? That means that if you take, theoretically, right, what that means is that you've got over 95% of the population working. So if you're of working age, you should be working. And according to the employment statistics, almost 95% of the, you know, more than 95% of the available population is working. You're never going to have 100% employment. There's always a group of people that will be unemployed for a variety of reasons, right? They just got laid off. They're, you know, going out to start a business, whatever they're doing, right? But you're always going to have a portion of the, and you got those that just don't want to work, right? So there's always that group of people. So you're never going to have 100%, but when you're hitting 95%, that's pretty much full employment historically speaking. The problem though has been really since 2000 as we take a look at the participation rate. So the labor force participation rate says, okay, out of all the people that should be working, how many actually are participating in the labor force? Now, that number is going to be lower than 100% of people above the age of, say, 16, right? So once you're 16, you can go to work. So if everybody worked and the entire population was over the age of 16, then you'd have 100% labor force participation. Now, look, you're going to have husbands and wives, single income households. So the spouse is not working, the other spouse is. So you've got people that are not working in the labor force for a variety of other reasons, disabilities, whatever. So you're never going to have 100% labor force participation rate. But in 2000, arguably, we had a very good participation rate in the economy of almost 67%. Since 2000, that labor force participation rate has been dropping as we've gone from one kind of crisis to the next. So in 2000, economy's booming, .com innovation, internet, the whole nine yards, right? And then we have the .com crisis, and the labor force participation rate falls off as companies go bankrupt, they go out of business, people lose their jobs. It rebounded a bit heading into the financial crisis, got up to about a little over 66% participation after falling below that level. And then during the financial crisis, the labor force participation rate fell from that 66% level down to 62%. Very sharp decline. The last time we were at a 62% participation rate was really kind of back in the 1980s. But the difference then is the participation rate was not falling, it was rising. So after the financial crisis, and then really at about 2015, 2016, the economy starts to kind of do a little bit better. Kind of got past all the scars of the financial crisis, and the labor force participation rate started to kind of pick back up. We got up to about 63.5% participation rate. Not a great recovery, considering we spent $43 trillion of fiscal and monetary policy between Fed bailouts and government stimulus, et cetera. We were only able to marginally improve that labor force participation rate. And then, of course, when we shut down the economy, that participation rate plummeted to 61%. Now, it's recovered here a little bit. We're back up to about 62%. Now, 62% is lower than where we were following the financial crisis. So now, what people immediately assume is like, well, that's just all the retirees, right? So we had all these baby boomers. They're coming off the rolls now. They're all retiring. That doesn't really fit the scenario. Yes, baby boomers are retiring, but you've got Gen X and millennials coming up into the labor force, and that 24. And so if you're over the age of, say, 24, 25, and you're under the age of 55, you should be working. And the problem is that the labor force participation rate of that 25 to 55 category is also dropping. And in fact, the labor force participation rate for men has been declining ever since 1950. And so there's more to this. Here's my point. There's more to this story than just baby boomers are retiring. That's too simple of an explanation. And the other problem that we have with the employment statistics, et cetera, all really relate back to one other, primary problem is how we count things. So when the Federal Reserve is talking about, hey, we're near full employment. Really, how do you explain full employment when you've got 13 million people missing out of the labor force since 2000? You've got 10 million people that are just absent from the labor force since 2009. Where are they? These are the uncounted millions. They're out there, they're doing stuff, right? But if you're working 3 part-time jobs, if you're working 80 hours a week, you're not considered employed, though. So this is how we adjust for things. You know, one of the other adjustments we make for employment is the birth-death analysis, which is this guess at what's happening with small businesses. And the Federal Reserve said, the Bureau of Economic Analysis says, well, people are leaving the labor force, yes, and they're starting their own businesses. And so we just assume that every month that we have X number of businesses getting started and they all hire people. Well, we just went through the statistics recently here that shows that that's absolutely not the case. In fact, the number of small businesses in the country hasn't changed in like 30 years. It's been flatline. Businesses go into business, they go out of business, and they're replaced by new businesses, right? I mean, it's just a turnover. So that doesn't really explain it. But what it does explain a lot of this is that there's more to this story about employment than what the economic analysis tells us, or the economic story tells us. It tells us that there's a whole chunk of the population that is working multiple part-time jobs. They're outside the labor force for a variety of reasons. They're not working. They're figuring, you know, we've talked about this numerous times on the show, is that, you know, if you know how to work the system, there's enough monetary support between a variety of government programs, welfare, etc., that you can cobble together enough income to live on. Now, you're not driving a Maserati, but you can make it work. If you're willing to live that, you know, kind of that meager lifestyle, you can do it. And you can not work. And we're seeing more and more of this really start to reflect in some of these economic numbers. And you've got to kind of dig down behind the story. You know, we see these headlines of these employment reports. You've got to start asking yourself the question, well, why is that way? Because it has an impact. And this is where we go back to talking about the deflationary pressures in the economy. You know, the reason that everybody wanted to, you know, and again, look, if you're going to give people free money, there's nobody who's going to turn down free money, right? But why is there such a demand for socialism? Because this idea of socialism is more free stuff. I want more free stuff. You know, pay for my college. Pay for my, you know, give me money to spend. You know, give me more unemployment benefits. Give me more child tax credits, those type of things. Give me free money. But the problem with it is that that's not a productive use of money, and it leads to slower economic growth. So the whole point of the story is that this is one of the big drivers of deflation in the economy as opposed to inflation. And this is why, if you take a look at socialistic countries, they always have a problem with inflation because, again, if you give people free money, that's fine. They're going to go spend it, but they don't produce anything. And if you don't produce anything, you don't have economic output, which means your demand outstrips your supply. You have inflation. But the bigger story behind this whole thing, when we're talking about inflation, deflation, Fed policy, all this type of stuff, pay attention to what's actually going on with the labor force participation rate. It's telling you a lot more about the state of the economy than the simple excuse of, well, it's just baby boomers retiring. Because that doesn't account for the big decline in labor force participation in the 25 to 54 bracket. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will the Fed's actions this week mean for your money next week? Join Lance Roberts with Richard Rosso and Danny Ratliff for a special edition of Candid Coffee this Saturday, January 29th at 8 a.m. We'll address market conditions post-Fed meeting. Will it be slow or go for Wall Street? And how will the Fed's stance affect your investments? Register now for our special edition post-Fed Candid Coffee at realinvestmentadvice.com. Candid Coffee with Ratliff, Rosso, and Roberts. realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. realinvestmentadvice.com. Click on the insurance tab.
What worries you about your money? Enhance your financial success with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com. Click on the Client Portal tab, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. I'm Lance Roberts. Okay. Enough about inflation, deflation this morning. You get the idea. The real risk to the Fed, and again, as they have this meeting tomorrow. Actually, they're having their meeting today and tomorrow. We'll get their statement tomorrow, which is going to be diced, sliced, and analyzed 9 ways to Sunday. And of course, their FOMC statement after the press conference after, where he takes Q&A. Questions, of course, everybody's going to be focusing on monetary policy. Are you tightening it or not? Are you cutting the balance sheet or not? What's your view on inflation? That's it. I mean, everything else is not even going to be on the radar. It's all going to be about the inflation. So we'll see. It's all a guesswork till now then. The market's trying to call the Fed's bluff at this point. We'll see if who wins, if the market's putting enough pressure on the Fed that the Fed backs off. And we'll know. It was interesting. I was driving in this morning, and I heard a clip from Psaki, who is the White House press maven. And she said that unlike his predecessor, the president is not focused on the stock market. So, it's an interesting statement because the stock market, ever since really President Obama, has become a measuring stick of how well the president's policies are doing. And every time the market's doing well, the president comes out and says, well, you can tell by the stock market how good my policies are working in the economy, et cetera, so forth and so on. And Trump went right on with that same type of analysis, tying a lot of performance of his policy back to the stock market. Really, the two don't have a whole lot to do with each other in a lot of cases, but it's an easy measuring stick. Well, it's obviously not working right now for the Biden administration, so it's not surprising for them to try to distance themselves from it. But the real issue, of course, is that the Fed is a political animal. And Jerome Powell almost lost his job in 2018 under the Trump administration. There was all kinds of articles about how Trump's going to fire Jerome Powell because of the stock market crash of 20%, so forth and so on. And it wasn't long before the Fed reversed policy. And this is not just Jerome Powell. This was under Yellen. It was under Bernanke as well. And, of course, those two presided under the Obama administration. But, policy has a lot to do, and politics has a lot to do and a lot of effect on Fed decision-making. The Fed is not an independent animal by any stretch of the imagination. You can't be independent when you're owned by the major banks. And you can't be independent when your job is dependent upon nomination by Congress and politics. So, this idea that the Fed's going to be totally independent tomorrow and they're just going to be solely focused on inflation is a little bit disingenuous, because politics are going to be playing a role in this. Well, and again, so we'll see, and again, what's pressuring, if you take a look at the approval ratings for President Biden right now, there is a direct inverse correlation between his approval ratings and the rise in inflation. So, there is a lot of pressure on the Fed to fix the inflation problem. So, that's what we're going to be watching for tomorrow. Everybody's going to be watching for that tomorrow. So, a flying car has now gotten a green light to take flight in Slovakia. Car is capable of flying 2 people at 100-mile-per-hour speeds and then go drive down the freeway. I just have a question for you. I am sure when the Wright brothers first invented the airplane that there weren't a whole line of people standing out there going, yeah, I want one too. I think flying cars are a really cool idea. I don't think I will probably ever own one in my lifetime because, it's one thing to crash in your car when you're on the freeway. It's another one to crash from a few thousand feet or so. And I just have a suspicion that they don't glide very well. That's the that's the thing. But look, it's the whole, and then there's going to be the whole FAA licensing thing, and it's just, and then you got drones. I mean, pretty much, Houston traffic is going to all move up, right? And so that means freeways are going to be open. So I'll just keep driving my car. I think I'll just be just fine driving.
I can't wait for 3-dimensional traffic reports.
Oh, don't worry, that's coming. In your VR headset.
Yes.
Did you actually see what the inventor of the Sony PlayStation said yesterday?
I did not.
So the inventor of the Sony, I am summarizing what he said because it was obviously in Japanese, and so my translation simply turns out to be that's the most stupid idea I've ever heard of. People don't want to sit around with VR headsets on and be in this virtual world. That's his view. Of course, he's the inventor of one of the most popular gaming stations, on the planet. Don't know if he's right or wrong. He's old. He's an older guy. So,
boomer.
He's a boomer. Yeah. So he doesn't get it, right? He got it with the Sony PlayStation, right?
Yeah.
But he doesn't get it now with the whole VR thing. But, Facebook's changed their name to Meta, and, they are pursuing the metaverse, which is this world that you'll be able to live in. I strongly advise you, if you have any interest in the metaverse, is to go watch Ready Player One. And not from the movie standpoint. Look at from the economic, socioeconomic commentary that is underlaid behind that. There's actually a story about the ills of creating a world where everybody lives in an imaginary one, where you can be whatever you want to be. It's not a great outcome. It's not a great world to be in. But this comes back down to, we were talking about a few minutes ago about employment and work and productivity, building things. if everybody's spending all their time in the metaverse, it's hard to be productive. You can't really build a building in the metaverse, which really kind of comes down to this whole idea of NFT real estate, where you own a piece of real estate in a virtual world, right? And people are paying exorbitantly high prices for a piece of real estate in this metaverse that you can create an infinite amount of. There's a old saying about with real estate, the reason you should always buy real estate is that, God's not making any more of it, at least on planet Earth. So there's only so much real estate. There's a finite limit to the amount of real estate available to buy on the planet Earth. In the metaverse, there is no limit. And if there's no limit to something, there is no creation of demand. If you create something and I think you're charging too much for it, I'll just go build my own, right? And there will be all kinds of tools and developments for you to build your own metaverses. This will become the next thing. And it's going to be interesting to see how this all works out down the road. But, this is, it's kind of a very interesting transition. We're very early into it, and it's interesting to watch. Lots of people are coming up with, ideas about how this virtual world will be very useful, and it's true. You can run, for instance, you could run highly dangerous experiments in this virtual world and at no risk, right? So I can do chemical compounds. I can do a variety of things in this virtual world. I could train, for instance, I could train people to be a bomb disposal unit, as an example. I could train people to defuse and dispose of bombs in a virtual world to where if they mess up, right, there's no consequence. But I can teach them the tools and the techniques that they need to know in that world. So there's definite uses. I don't want people to think it's like I'm just saying the metaverse is stupid. And I'm not saying that at all. There's definitely uses for that. But in terms of people moving to the point of where I'm buying, virtual real estate and it's going to be an investable asset like real estate is incorrect, because there is no limit to what I can create in a virtual world. So it's interesting to watch though, but it'll be something that, and Facebook's making a big bet on this, and Microsoft is too. And Microsoft is working, this idea, this metaverse is something that is going to dominate a lot of the digital platforms as we start to go forward. And the question is going to be viability of it outside of the entertainment space. And do you start getting in, if it starts to make a migration into, again, you could teach doctors how to perform surgeries in this virtual world without risking, life, right? So there's a huge amount of opportunity there. And the question, of course, is, as with everything, is going to be who can actually take advantage of it and create a useful product out of it outside of just the entertainment. So we'll see. I think it'll be fun to watch. Still not flying a car. It's not going to happen. Those things tend to end at the first crash, right?
Abruptly.
It was a great idea until it crashed. But look, there's a lot of them. They just came out with the Jetsons 1, right? So lots of flying cars on their way. So, hey, if that's your thing, let me know. All right, wrap the show for today. Be back here tomorrow for the next edition of The Real Investment Show. Get our website. New articles posted out today on the website as well. And again, we'll see what happens with the Fed tomorrow. We'll keep you all up to date on markets, money, and more right here at realinvestmentadvice.com. See you tomorrow.
It's a rich man's world.